So this year, if you look at, is a period, calendar year 23, is going to be a period where you will see a lot of asset classes actually moving in a narrow range in terms of returns. I mean, last year, if you look at the lessons from last year, would be that we saw huge amount of uncertainty. If somebody had told you that there would be a war, Russia-Ukraine war, there will be unprecedentedly high inflation. U.S. hike in interest rates, okay, will be at record levels, and there will be a kind of a global slowdown or recession in the near term. In that scenario, you would have thought that the markets, okay, would have given negative returns, and indeed, so actually, a lot of the global markets gave pretty negative returns. India market was still slightly positive. So I think one thing that learning is that while the sentiments and there'll be a lot of noise around, but if your fundamentals are good, then you should do well. So I mean, reacting on those news, if somebody had sold early, then probably he would have missed out on the market in the longer term perspective. So that's I think the key learning. I would say that volatility and uncertainty, despite that, India actually has emerged very strong. I think the India growth story overall is looking very good. So you talked about decoupling, right? So Indian economy in this whole crisis is looking fairly strong. It's more driven by domestic demand, which is there, and a lot of factors, okay, which were hurting the economy the pre-pandemic. A lot of sectors are now looking up. So, and also for India perspective, if you look at commodity prices, right, which rallied because during the Russia-Ukraine crisis, I think that has now kind of come off. So that should, India is a net importer of commodities, so that should aid a lot of companies. So that, in a sense, I would say that I mean, last year, pretty uncertain period, but I think we have still managed fairly well. And also, I think the bigger learning was that the strength of the domestic investors. And I mean, last year we saw record outflows from FIs, almost to the tune of around 26 to 27 billion dollars. And despite that, the market was able to hold on because domestic investors came into the market in a big way. We have seen that trend play out post the pandemic. A lot of new investors have come into the market, and the breadth of the market has improved. So I think that brings a lot of stability to the market. So it's not like a driven by one force, okay, which was foreign financial investors, which is to really keep the market very volatile. So I think the emergence of domestic investors and also in large size is also one of the key highlights of last year, I would say.
Indeed, lots of points to consider. As Mahesh, you said, focus on the fundamentals. That was the key lesson to be learned from 2022. And as we are coming off the effects of some geopolitical inspired changes, it's also interesting to see how the market dynamics are changing. As you mentioned, domestic investors have come out in full force, even as FIIs kind of move their money away, which has provided stability. But on the point that you mentioned of potentially narrower returns coming in for this year, that will bring up the conversation around, say, rebalancing portfolios, whether investors have it with themselves or with their advisors. So from your point of view, what are the things that investors should keep in mind when they go about rebalancing portfolios?
Yeah, so I think while rebalancing the portfolio, and why do you do rebalancing of the portfolio? It is because for a particular investor, right, based on your risk profile, you would have had certain target allocation, asset allocation, say towards equity and debt. If you look at these two are the two main asset classes which are there. So normally what happens is that because of sharp movement in a particular asset class, you would see that the asset allocation changes over a period of time. So I think it's important that one rebalances the portfolio so that the overall risk of the portfolio comes back to the potential risk assessment of that particular individual. So in that sense, I think the rebalancing is important. Again, the target allocation for any particular investor asset allocation depends on one's risk profile. So if you are a high risk profile investor, then you would have a larger allocation to an asset class like equity compared to debt. And it's also important to understand that what is the period of rebalancing, because that is also equally important. When do you really rebalance the portfolio? So I would say that now people have various time frames, okay, 1 month, quarter, 6 months, or a 1 year time frame. But I would like to believe that typically an asset class, okay, the cycles are slightly longer, right? If they play out, it will be slightly longer, say more than a year time frame. So I think it would be better to rebalance the portfolio, say on a 6 monthly, on a 1 year basis. I think that will enable you to ride also on a particular asset class, okay, which does well in that period before trying to rebalance too early also. So, and that is another thing which I think one needs to keep in mind. Obviously, rebalancing a portfolio does not necessarily enhance the returns, okay, of a static portfolio, right? For example, your asset allocation, target asset allocation was 50% equity and 50% debt. And if you I mean, if you are doing a rebalancing of the portfolio on a say 6 monthly basis, then the returns will be similar. But what it does is that it tends to sell, okay, when the particular asset class returns are on the higher side. So basically, you sell high, and you put that allocation back again to the target allocation on the other asset class, okay, which has not done so well. So you buy other asset which is normally lower. So that enables you to also reduce to some extent the risk and volatility, because normally when something goes up over a period of time, it has a tendency to mean revert and again go back to the normal. And that normally leads to a volatility. For example, if equity allocation from 50 goes up to 70 because of sharp increase, and if you don't rebalance the portfolio, and then 70 can again go down, okay, back to 55 or 60 levels, and that can lead to volatility. But if you rebalance the portfolio again, then the overall volatility of the returns goes down materially.
All right, bringing into focus the point that you mentioned on risk and correlating with age, at say at which someone starts investing and looking at their risk taking abilities. What do you think is the correlation between age at which someone starts investing and their risk taking abilities? And according to you, how does it impact their returns in the long run?
So there is a, I mean, if you look at the early you start investing into the market, and especially we're talking about investing into equities because that's where it really matters, where the risk is also equally higher. So as you increase your time horizon in the market, we've seen that the chances of negative returns in the markets go down. Because as you know, in the shorter term, market can also give you negative returns and significant negative returns. We have seen that in certain periods, markets have given negative returns to the extent of around 25-30% also. So as you increase the time horizon, the chances of negative returns goes down, and then you can take a larger exposure to equities because you have time to your advantage. So by that corollary, if you are young and if you're starting early and if you have got a long period in front of you, your working career, then in that scenario, you can actually have a larger equity allocation is what you can do. And progressively, as as you mature, right, age grows and your period, I mean, of total income generating period starts to go down, and you start looking at more retirement, then your overall equity exposure, okay, starts to go down. So that's how I think one should be looking at. I think for all youngsters who are there, I would advise that I mean they can have a very large focus, because I think over a 10-year period, if you see, equities haven't given negative returns. I mean, in the worst of the crisis, right? and long-term returns in equities are normally better. So if you look at long-term, I mean, compared to say debt, it will at least be around 7% higher. So you can actually also benefit from the power of compounding. I think you talked the chart about inflation, okay, how it changes, but compared to inflation of 7%, if your equity portfolio gives a return of around say 13% or 14%, double that, because that's been the average returns, then over a longer term, if you have a longer term time frame, you start investing early, then the power of compounding can really materially increase the corpus, the end corpus of the portfolio. So I think that's
Hmm.
how I think the risk taking ability and the age factor I think should really be played out.
Absolutely. And this is a point which we discussed in the previous panel where time needs to be on your side so that the power of compounding can work for you as an investor. But looking at the current circumstance, the current landscape where there is a possibility of market volatility and, of course, interest rate fluctuations in the coming months, Mahesh, how should debt instruments be placed in one's portfolio? What's your thoughts on that?
So calendar year 2023, as I mentioned earlier, is going to be a year where the returns across asset classes, whether it is equity, debt, or even gold for that matter, right? The other precious commodities, we see them in a pretty narrow range. And this year, what we are seeing is that debt is also likely to emerge as a asset class which investors should not ignore. uh, I mean, if you look at in the last 1 year or more than that, people had forgotten investing into debt because the interest rates were very low, right? Because all the central banks had cut interest rates during the COVID period, and banks FDs were like below 5%, and there was a more flight towards equity. But now interest rates have moved up significantly by almost 200 basis point or 2 percentage points, and that is offering now a reasonable return, uh, anywhere between 7.5% or so, which is pretty attractive considering the fact that equity returns this year would also be probably around high single digits, though long-term equity would still generate good returns. So in that scenario, if you're investing, say with a 1 year view, or say less than a 3 year view, then you need to have debt also as a part of a portfolio, where the return normally equities, to invest into equity because of the volatility, they would require at least a 6% kind of a risk premium. That means if debt is giving around 7% return, then because of the higher risk in equity, you would at least want equities to give you around 13% kind of a return, which I think would looks difficult from a short-term perspective. Though I think over a 3 year time frame or more, equities can still give that returns. So I think in the current scenario, a balanced approach towards asset allocation, and within that, debt is important component, because debt provides stability to the portfolio. Because I mean, there the in debt we've seen that the downside is very limited, and you can also probably add gold as an asset class. Okay, not in a large quantity, but some part of your asset allocation can be there. Normally we have a multi-assets fund, okay, where we have a combination of equity, debt, and gold. Gold will provide you some amount of protect. It kind of gives you hedge, okay, against any market volatility or in a crisis, and which we think we are not out of that as yet. On the debt side, again, coming back, there are a lot of products, okay, which are there in the market, especially in the mutual fund side, like the target maturity plans, okay, which the risk, okay, if it is your investment horizon, okay, matches the duration of the instruments, so there is no risk of interest rates, okay, which can lead to volatility. But by and large, I think products, accrual products, okay, with a 1 year or a 2 year, 3 year kind of a duration, look fairly attractive at this point in time, and one can invest in them through some of the short-term funds, or the floater funds, okay, which are there, or the bond funds. I think can be attractive for investors to look at as a part of their asset allocation.
All right. Patience has been one of the key words emerging out of our conversations in Nivesh Mahakumbh 2023. So, Mahesh, from your perspective, I want to understand why should investors continue to keep believing in the India growth story? We've got a budget coming up. So, from a rationale perspective, what are your thoughts on why investors, whether they're domestic or global, why should they continue to keep believing in the India growth story?
So I think India, has emerged now as a leading economy. We are already the fifth largest economy now, and a lot of reforms which have happened in India in the last 7 years, be it, obviously with a strong and reform-oriented government, whether it is in the banking and financial services sector, the GST implementation, the RERA, which was introduced in the real estate sector, the whole digital transformation in terms of the UID. This is paving the foundation for India's next leg of growth, we think, over the next decade or even beyond that. And that would continue to drive our economic growth. We are also seeing that the global scenario, okay, geopolitics globally, is likely, India is much better placed in that scenario. And there's a shift also globally towards moving from China, right, to other manufacturing locations. And India will now adding the largest amount of working age population, okay, in the world. And that would really be, if that is tapped properly, then India can be a large manufacturing base, also supplying not only domestic economy, but also to the global world. So I think all these factors, okay, enablers, okay, are in place. Also, India's demographic profile is also very favorable. India is still pretty young population. We saw China actually now go beyond that a few years back, and that will also drive consumption, especially discretionary consumption. Your per capita income, as it moves up, you'll see demand for a lot of discretionary consumption, be it in the consumer durables, retail, auto sector, would also move up. So I think all these factors lead us to believe that India over the next decade will continue to grow, say around on an average around 6.5% or so. It could be even higher if there is support from the global economy, which we are seeing this year is going through some of a challenge. And India will become the third largest economy by 2023. And if that happens, automatically companies will do well, right? Because companies' earning growth are in turn dependent on how the economy does, and if that happens, then markets will also do well over the longer term. So I think that this is a time where India should not lose. If we have political stability, as you talked about elections, which are there next year, we have budget also, which is there. Hopefully, the budget will try to stimulate domestic consumption because that has still recovering from the pandemic, especially rural consumption. And if that gets a boost in this budget, you will see the recovery in India, okay, can probably be much better.
All right. Another point highlighted in some of the earlier conversations was that investment in these times, especially considering the volatile times today, investors in India especially need to be more strategic in their thinking versus tactical. What are your thoughts on that?
So I would tend to agree that because um, tactically it's very difficult to predict, okay, which asset class will do well because there's too much uncertainty. As I said, there are too many variables which are there, and trying to, and a lot of, even within equity we see a lot of sector rotation is happening. So taking a tactical approach might not be the right one, because many times what happens is that how you expect the market to react to a particular situation, okay, is not exactly what it happens. Market probably does the other way around, and that would mean that you will not be able to always get it right. But taking a strategic decision and planning accordingly, then I think in the longer run, actually, it is the more fundamentals, okay, as we discussed, okay, that will drive the outperformance or the returns in a particular asset class. And if long-term outlook, say for example, say in equities for that matter, as I said earlier, is looking good, then you don't worry about too much what's going to happen in the next 1 year. I mean, next 1 year could be, as I said, year of pretty muted returns for equity, but that should not really change your long-term goals, right? What you're planning to save and invest for your needs, say 10 years down the line, I think that should not really bother because of any kind of short-term movements, and one should not tactically change the portfolio because of that. So I think increasingly, I think it's important to have a more strategic, long-term approach in terms of your financial planning, asset allocation, to be able to really benefit out of the I mean the true potential, okay, of the various asset class, okay, what they offer.
All right. Words from the wise. Before we let you go, Mahesh, bringing it all together, what do you think is the key message that the investing audience watching Nivesh Mahakumbh 2023, watching our conversation, what should they take away, especially in terms of, say, avoiding some of the usual mistakes folks make when they look at investment?
So I would say that I think a lot of earlier panelists would have also covered that. But I think the usual mistakes people make is that looking at the past and then try to judge the returns for any particular asset class. So, I mean, we've seen that, I mean, especially in the last 1 year, if you look at equities, haven't done all that great. Probably this year also, it might not be very great. But that doesn't mean that the long-term returns for equities really change, because we see time and again, despite various crises, markets tend to deliver those returns. So I think don't look at the past and try to make your future investment decisions. Uh, I think, stick to your asset allocation and do regular rebalancing. That will help you to build the discipline and ensure that you don't take unnecessary higher risk, because that can lead to one actually taking wrong decisions, right? Because when you over expose yourself and there is volatility, then investors tend to become more conservative, right? Risk averse, and then they probably take the wrong decisions. So, and have a slightly long term approach, right? Because that will take away the fear of uh, volatility in returns because of the market factors. So I think three will be the key takeaways I think I would like investors to take away.
Well, thank you so much, Mahesh. Indeed, patience and discipline. These have been the key words which have been coming out of our conversation so far. And thank you, Mahesh, for simplifying investment mantras that all of our viewing audience can make use of in the coming year. Thank you so much for giving us the time here on this fireside chat.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.